that's still not going to do it. It's a good thing I started. You had me do that, though. Thank you very much. Oh, come on. There it is. Okay. All right. So the face amount was $100,000. Remember? It's got written down there. The stated rate was how much?
8%.
That only determines how much interest there is, right, guys?
Yeah.
Okay. It was semi-annual, wasn't it? That's just stated feature. Semi-annually. Okay. Which then means what? 4% every 6 months times the 100,000 will give us $4,000 interest payment, right, guys? That's an annuity payment. That's how you value that thing. And the face is a lump sum, right, guys? Okay. And then what we did was the term maturity date, right, is, what was it, 5 years now?
Yeah.
1 years. Okay. So 8%, 5 years. We got it. Okay. But how many periods is that? Obviously, if you do semi-annual. 10. And if you get that, and don't memorize it. It's common sense, isn't it? Yeah, sure it is. There's 2 semi-annual periods per year. Okay, so just pay attention when you read the problem you got to make. Okay, not anything to remember really. Okay, flashes the whole time. I think we're okay. Scary. Okay, all right. So what we want to do then is the accounting for this. What was the present value? When you did the present value, we used 2 different discount rates, didn't we? So if the effective or yield or market rate was, what did we use? 6% and 10%? Is that what we did?
Yes.
Okay, if it was 6%, okay, it's going to be sold for a what? The market only wants 6. This thing pays 8. It's going to go for a premium, isn't it? So you would expect it to sell for more than the 100,000. Right off the bat, you know that. So when you do your calculation, it becomes in less. You did something wrong. Okay, that's nice, isn't it? Okay, and then the other effective rate we used was 10%. And that's more than the 8, so guess what? Nobody likes this thing, and they bid the price down. They'll bid it down until it earns 10%. In the case of the 6%, they'll bid it up until it only earns 6%. Is that the idea? Okay, so what was the present value under these 2? The present value of the whole note, or the whole bond, I'm sorry. What was the present value we came up with? Whoops, this one's the 92, right? 92, 277. Okay, good. Right? And then the other one, whoops.
108,520.
Okay. Here we go. 108,520.
3.
Oh, 3. Oh, man.
No, 530.
You guys are messing. Okay, all right. 108,530. Good. How much cash is going to change hands if this is the situation? 108,530. That's what it's worth. Got it? How much cash is changing hands if this is the situation? 92,277. That's it. On both sides of the deal, of course. You know what? If you buy a bond from me, I get the amount of cash you give me. Duh. Right? Okay, so don't let this be a big deal. So let's do the one first where there is a discount. Which one's the discount? Obviously this one, right? This is a discount. This is a premium. So let's do first the one with the discount, okay? So if you have a discount, what's it going to look like on both sides, okay? So what I've got is, here is the issuer, who is also the borrower, same person. They issued the bond, they borrowed the money. And they're also the seller. You view it that way. You think about them as being any of those people. Make sense? Sold the bond, they issued the bond, right? They borrowed the money, okay? On the other side, these guys are what? The investor. The other company's buying it, right? Or individual, okay? Investor. Lender. See how those match up? Investor and issuer, lender and borrower, and purchaser. It means the same thing. Got the idea? No big deal, huh? So let's say this bond is dated January 1st, year 1, okay? And then the interest payments are going to be every 6 months. So what is it, June 30th and December 31st? Sound good? Everybody got it? Okay, so the bond's dated January 1st. Good enough. All right, let's record on January 1st what would happen on both sets of books. And it's year one, just year one, okay? What happens to the issuer? They debit cash, of course. Oh, by the way, what happens to the investor? They credit cash. Sure, always do the easy part first. How much cash, everybody? You would have calculated it, right? That present value you calculated is the cash. Absolutely. It's 92,277, isn't it? By the way, if it goes to the premium, it's going to be 108,530, right? Whatever it was issued for. Okay, what do we call this thing? For the people borrowing the money, what do? By convention, we record this is a bond that I'm going to pay later, so I call it a bond payable. Clever. What kind of account do you think that thing is? Liability. Long-term or current? Seeing as it's due in 5 years. Long-term. It's too easy to believe, isn't it? But you know what you're doing. This is nothing. Okay? So let's call it a bond payable because that's what it is. Now, by convention, we show, that's a P. Okay, okay, bond payable. By convention, we show it at the full amount here. Okay? Got it? So that means I have to have a debit to make my journal entry balance. How much is it? 7,000. What do you say? 723. That was, we call that a what? Seeing as it's less than the base amount. Careful, it's less. They lower the price, a discount. Discount, and cleverly, you bet, discount on bonds payable, right? Discount on bonds payable. Got it? Okay, you tell me what kind of account that is. The amount what'd you say?
Contra liability.
Oh, way to go. Contra liability, right? What account does it go with? The bond payable, of course. What is the bonds payable carrying amount, really? How much do we borrow, really? We didn't borrow 100,000. What did we borrow? 92,277, right? So your bond carrying value on your balance sheet, listen to this one. On your balance sheet, it's going to be just like equipment less accumulated depreciation, right? Is your carrying value of the equipment, book value of the equipment. Got the idea? Or accounts receivable less allowance for doubtful accounts, that contra account, right guys? Is your net realizable receivable? Here what we're going to do is we're going to take the bond payable less the discount is the amount that we owe, which is the net bond payable. Got it? Nothing to it. If it's a premium, you add it. If it's a discount, you subtract it. You'll see that in a minute. Okay? So it's just not a big deal once you get your head around it, is it? It's a big problem, but each piece of it is simple, right? Okay? Get each piece. What's going to be the case here on the investor side, of course? They don't debit bond receivable because that's not how they're viewing this thing. What do they view this as? An investment. And they call it a what? Investment in what? In bonds, but we call it held to maturity bonds. And that's going to be really important for us, okay? And that's going to be the debit. Sorry, I didn't take enough room to do that, but that'll be the debit, right? This is the debit. 92,277. Okay, debit, credit, okay? We put it all in one account, okay? For us, it's an investment. And what I mean by held to maturity is my intention is to hold it to the end. I bought it to get the interest over the term, yes.
Is that bonds connected to held to maturity?
Yeah, yeah, it goes with it. Investment in held to maturity bonds. Yeah, all one line, okay? I should have had my credit up over further, got it? Okay, good. Okay? Are we good, guys? It's an investment for me. The reason we want to say held to maturity is if we're only going to hold them for a few days, they'll be a trading security. I can invest in a bond or stocks for only a few days. If I'm going to hold them for more than a few days, a few weeks maybe, and up to a year, it'll be available for sale short term. If I'm going to hold it for more than a year but not to maturity, it's available for sale long term. Got the idea? And we're going to have a chapter later where we do that. That's the appendix. By the way, that appendix is not an appendix. It used to be a chapter in the book, and it's critically important. And if you're never going to have another accounting class, you really want to know about this stuff. It's what you're going to invest in. Okay? I don't know why they turn it into an appendix, and I hate that, because what do you immediately do when somebody makes something an appendix in a book? It must not be important. In intermediate accounting, we cover every single appendix in the book. They took all the critical, hard stuff and turned it into an appendix, because a lot of schools, they don't want the students to work very hard. They also apparently don't want them to pass the CPA exam because they don't have a prayer. So you want to learn this crap, right? You want to know what you're doing? Yes, you do, don't you? Okay. Also, I'm gonna make you do that still. Yeah. Yeah. No, anyway, not really. Not me. It's nice. Okay, anyway, good deal. So that's the beginning, huh? What do you suppose is going to happen next? What happens with this bond next? Just what happens next? What do you think happens next? You know, you borrow the money or you invest the money, and then what happens? There's interest payment. When do you think the interest payment's going to be? Assuming you don't sell it, and an intermediate will have to sell it, okay? We won't do that yet. Okay, if we sell it, intending to hold it the whole time, we don't. Okay, so it's going to be in 6 months. And oh, by the way, what if we bought this bond mid-year? We would value it differently, right? In between interest payments, we'd value it differently, and we'd have to pay for the interest that we're going to receive later, and all kinds of stuff, right? That gets more complex. We'll keep it simple here. I'll do it at the issue date, right? Okay, when they first did the bond, and then 6 months later. So it's going to be just like I'm showing you here. But this is the simplified version, okay? All right? Still the same concept. So at June 30th, you guys think, year one? Is that when the first one would be? Okay, now what we need to do is we need to get rid of this discount because we're really using it up. Now you guys tell me, how much money was borrowed here? How much was borrowed? 92,277. I think they borrowed 92,277. Don't you guys? I think they borrowed 92,277. What I've got here is I have bond payable with 100,000 in it, and I have discount on bonds payable with 7,723 in it. And what's the difference between those two? 92,277, right? So what I'm going to do, everybody agree? Yeah, that's what it is, right? That's just these numbers. Okay. 92,277 is the amount I have borrowed, right? What's my interest rate? Be careful. My interest rate is not 4%, that's the stated rate. What am I effectively paying if I borrow the money, or effectively earning if I lend them the money, right? If I invest in the bond. It was 5, wasn't it? Half of the 10. Exactly right. Don't switch to the stated. Real common mistake, right? If we discounted at 5%, we better unravel the deal at 5%, or you'll never unravel it, right? I mean, it'll never work out. It won't go back to 0, okay? So what we're going to do is we're going to amortize this discount over the life of the bond, okay? So the interest rate we want to use is our effective rate, okay? Or yield or market rate, whatever you want to call it. Good. That's 5%. What is 5% of 92,277? You guys have to do this. I have no idea what that is. 9,200. 92,277 times. Yeah. So it's half 9,027. What do you get?
I got $4,613.85.
Okay, we'll just round it, okay? In real life, of course, you use the pennies, people care, okay? But $4,614, everybody got it? Guess what that is? That's the interest I incurred, which I am going to call what, because I borrowed the money. And time went by, and I used up its value. Used up the utility of using it, right? I took the money and invested it in something, land, building, equipment, right? Now I'm generating revenues with. So what is this? This is the cost to get those revenues. It's expense. And it's for interest, of course, so we call it interest expense. Oh, wow. And it's going to be $4,614. Oh, wait, this is all screwed up. We got a problem. How much cash are you giving them? What's the cash, everybody? What was the cash they were paying them every time? It's a $100,000 bond. Stated rate was 4% every 6 months, right? 8% a year. So it was 4,000, wasn't it? Remember that? So how much cash are you going to give them, of course? 4,000. Uh-oh. That journal entry doesn't balance. That's just fine. Because here's the deal. My expense is 4,614, but the cash I'm giving is only 4,000. But remember, at the end, when I pay this bond off at the end of 5 years, I'm going to give them an extra $7,723, aren't I? Right, guys? Because I'm going to give them 100. They only loaned me 92,277. So there's more interest I'm paying than, right? Than the 40, was it 40,000? 4,000, I said, yeah, than the 40,000, right? We already agreed that the interest is going to be 47,723, didn't we? Over the term? We did that last time, okay? So the way you get it into interest expense is debit interest expense for what the interest should be, credit cash for what you paid them, and then start amortizing. How much are we going to amortize the discount? Make your journal entry balance, that's all you got to do. 614, discount on bonds payable. So what you can see here, guys, is your discount on bonds payable is starting to go away, isn't it? Look at this. I'm going to credit that discount for 614, and I will have a new carrying value of the bond, won't I? Everybody see it? So what's 7723 less 614? What's the new debit left in discount on bonds payable? 7109. You guys are very fast. Okay, 7109, right? So guess what the interest is going to be next time? Now what do I have borrowed? It's like I borrowed some of the interest. You got the idea? I added it to the loan, right? The loan's going up, deducted it from the loan, right? I'm taking the interest out as I go. Okay, so it goes from 107, from 92,277 to what? 100 less 7,109 is what?
92,891.
Yeah, 92,891. After I've done this for 10 payments, what am I going to have left in the discount, do you suppose? Seeing as we discounted at 5%, now we're compounding at 5%. What's going to happen? The discount is going to become what? Zero. And the carrying value of the bond is going to be 100,000 less zero discount, or 100,000. Cool, huh? That's all we're doing. We're spreading the interest across using this effective interest method, right? Oh, by the way, they show you straight line in the book. Ignore that. Nobody on earth does that. Why not? Because it's simple to do at effective interest. You know why they have straight line in there for you guys? You're not supposed to be smart enough to do this yet. You're too young. Give me a break. You guys know how to discount, don't you? You know how to compound too? That's all it is, right? Just reversing the process. So everybody uses the effective interest method, right? So let's use that method. Don't worry about the other one. You know what straight line is. You take the full amount of the discount, divide it by the number of periods, and, do a straight line. Big deal. Nobody does that. And the authors will tell you, well, it's easier. Well, yeah, it's easier, but this one's simple too, so why would you do something just because it's a little tiny bit easier? I don't know. Beats me. Let's do the other one. What's these guys going to look like? What is the carrying value of the bond over here? You guys have any idea? This one's easier. What's the investment in held and maturity bonds? What's in there? Don't think about it too much. What is it? 92,277. Does that number sound familiar to you? Yeah, it's the 92,277 that's on the other side of the deal. Of course, it's the same deal, right? These people owe the money. These people are owed the money. That's it, huh? So guess what 92,277 is going to be taken by to find the interest revenue? We discounted at 5%. What do you want to compound at? 5%. What number are you going to get when you take 5% times 92,277? 4614. Only do it once, okay? Don't multiply that twice. That's a joke. Okay? Right? So what happens to the investor? What do they get?
4,000 in cash.
4,000 in cash. You have more cash. What are you going to do, everybody? It's an asset. They go on the left, and therefore you debit. Yeah, okay. Point. Right? You remember that, don't you? Remember is not the word. You know it. So debit cash and credit what? They earned
Interest revenue.
interest revenue. How do you increase revenue accounts? With credits. Just like you increase expense accounts with debits, increase revenue accounts with credits. I quit saying that stuff a long time ago. You guys know it. Use it, right? Put yourself, use it. How much do you think it is?
4,614.
4,614. Fantastic. And what's going to happen to the 614? Here we're amortizing the discount too, but we don't have a discount account. But the discount's still there. What's going to be paid off at the end on this bond? It's on the books at 92,277. What's going to be paid at the end? 100. What do we want that to grow to by the end?
100.
100. You got it. Over the 10 payments, it's going to grow to 100, right, with its amortization. So the discount's still there. What's in the investment in held maturity bonds is 100 less the discount, right? And we're getting rid of the discount now. So what we'll do is debit what? Investment in held to maturity bonds. Got it? It's too easy to believe, right? So now what we do is we put 614 into the investment in held to maturity bonds. We add it. And guess what you got? It's a miracle. I know the number already, do you? I don't even have to add it up. Why do I know that? It's got to be the same as the other side, right? It's going to stay the same on both sides. Just keep changing, growing to 100, right? Okay, I want you guys to do the second one, okay? It's not exactly the same entry. It's the same debits and credits, but it's not the same dollar amounts. You're still going to debit cash. Whoops, down here. You're still going to debit credit cash and debit interest expense and credit discount payable, but the dollar amounts are going to change. Over here, you're still going to debit cash, debit investment held in maturity bonds, credit interest revenue, but the dollar amounts are going to change. You know why? Because your interest is going to be different. Why is your interest going to be different? Because you owe a different amount, right? Or they owe you a different amount. So calculate what the interest would be. Go ahead and do that entry real quick. Bet you can do it. Notice I just keep having confidence in you guys. It's even getting to be founded looking at your last test. People say pessimist. Someday a student will learn something from me. Right? Maybe not from me, but other. So this is must be better for you. You guys got a number for interest?
Yeah.
It's going to be exactly the same journal entry. Debits and credits, just amounts change. One of the amounts doesn't change. Payment's always 4,000. Others will change. Got it done? 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 How are we doing? What you doing? Everybody ready? Good shot. Okay, this is going to be when, by the way? December, yeah, maybe the 1st or maybe the 31st, depending on how the box fits. Okay? December 31st, year one, maybe. Okay? Or maybe January 1st, right? The other one, then that would make the other payment July 1st, right? Okay? December 31st, year one. Okay? So the second payment, anyway. All right, how much interest, everybody? 92,891 times what?
5%.
5%. Slightly more, huh? How much is it?
4,645.
And every time it's going to get to be a little bit more. And guess what? That is going to be the interest expense and the interest revenue, depending on which side of the deal you're on, right? Because the carrying value is the same on both of them. It's 5% on both of them. Okay, good. So what's going to happen to the people that are loaning the money? They receive the cash or pay it out? They pay it out. That's credit cash, right? There it is. Credit cash, how much? $4,000. What are they going to debit? Interest expense, of course, because time went by and they have interest expense. That's it. How much interest expense? You just calculated. How much is it? 4,645. Even though we can't read Keith's writing. Okay? All right. And then I need 465 of something, or 645 of something. Discount on bonds payable. I'm amortizing some more of it. Wow. All right. So I have 465 coming out of the discount now, don't I? Or 645? Come on, Keith. What do we get? 7109 less 645 now.
6464.
6464. And if you want to do the next time, what will you have? What's your carrying value now? 100 less 6464. Right? Take that times 5%, you do the next one. Okay? Let's try on the other side. What do you bet it's still 4645 is the interest, only now it's revenue? What happens to the folks that lent the money, that invested in the bond? What happens to them? They get what? Cash, debit cash, sure, it's just that one. $4,000, it's always 4,000, it's an annuity, isn't it? Okay, so same interest payment, it's just a face times 4% every time. Okay, and then what are they gonna credit? Interest revenue, of course, how much? Okay, and what does that go to? We're amortizing the discount, and the way we do that is we add it to the investment, don't we? Investment in held-to-maturity bonds, and you just keep doing this. Period after period. On a quiz or test, I usually give a 20-year bond and have you do all of them. You know, all the periods. So you show. Okay. I'll have you do one or two periods and show me how to do it. Okay? Well, you got the idea, you just keep rolling forward, period after period after period. Okay? You're all thinking, yeah, he's even meaner than I thought. Okay, actually in intermediate I might do that. What I do there is I let him use a computer. In Excel you put in the first line with the formulas, and then you fill down, and it fills in the whole amortization schedule in a millisecond. Boom, it's done. I would never do that by hand. I wouldn't do this much by hand. I use Excel, right? This is just to show you how to do it. I could do this in Excel, but you wouldn't have a clue what I was doing with it. I just type in a bunch of formulas, and the answer would come up and say, well, that's easy. Yeah, sure. And then you do it, you type in a bunch of numbers, and some garbage would come out, right? And you wouldn't know why, so better to know what you're doing. Always know what you're doing. So, all right. So, we could do another one, right? Is that enough?
Yeah.
Switch premium. You got the idea, right? Okay, I want you to do another thing then. So there's the first, there's the second payment, I guess. Tell me what the balance is going to be in the discount after I do this 10 times. What's it going to go down to? Because remember, the credit to discount on bonds payable gets bigger each time, right? Okay, because the debt's getting bigger each time. Got it? So what's the discount going to be? Discount on bonds payable at the end, after 10 of them? Zero. So what's the carrying value at the end? 100,000. Everybody got it? Well, there won't be any more interest anyway because you're done. At the end, you're going to pay it off. Okay? What's going to be the value here? What's going to be the carrying value in the investment in held-to-maturity bonds after I amortize 10 periods, right? It's going to be 100. Got it? Okay. What I'd like you to do, this is really a hard one. I'd like you on that day, which is January 1st, year 5. Is that right, guys? Count right? Year 6. It's year 1 to 6. I thought that was wrong. You guys are as bad as me. It's 5 years. You started year 1. And January 1st, year 6. Okay? On that day, right, or December 31st, year 5. Either way. Okay? On that day, let's pay off the bond. Okay? Who gets what? Who gives up what? Pay the debits and credits. Just think about it. This is easy. Pray I give you this on a quiz test or fine. Free points. You don't even have to have the right value of the bond to do this. Just the face amount, right? By the way, on this type of problem, it's important to calculate the present value of the bond correctly. Yeah, everything goes crazy otherwise. It just goes nuts. Drives it insane. Okay. You know, it's supposed to be a discount to make a premium. Wow. Okay. Okay. The people that borrowed the money, what do? They pay it. Credit what? How much? You owe them $100,000 at the end, give it to them. Debit what? What are you paying off? Bond payable. And we already got rid of the discount by amortizing over 10 periods, didn't we? So we're done with the deal. We wrapped the whole thing up. Got the idea? What would happen on the other side? Guess what? They get the... These guys gave up cash. These guys get it. Right, guys? Guys, yeah. That's a new term. Sure it is. Sexist world I live in, I guess. Okay, debit, cash, and credit. What do we call it? Investment in held-to-maturity. So don't tell me bond receivable like people do. Where'd you get a bond receivable? We don't have one. We have an investment in held-to-maturity bonds. You have to go to accounts you're using, okay? Ta-da. We're done. Okay? Let's do the premium, huh? Switch to premium. Good. On the premium, what's going to happen? Okay, this is going to be a premium this time. Well, This time, I'm gonna have a carrying value more than 100 because, you know, the investor paid more, I borrowed more, right? I got more. If I issue a $100,000 bond and they give me $108,000, I think I borrowed 108. I'm happy about that, right? Because they're charging me less interest is why that happened, right? So I borrowed 108, okay? My interest expense is gonna be what, though? It's gonna be different because the interest rate's lower even though I borrowed more, right? I borrowed more, but the interest rate's lower, okay? So it's gonna look different than the discount did, that's all. Will allow us to amortize the premium, but it's gonna be the same process, you guys. So the premium was, what was the discount rate we used for the premium? 3% was it?
Or it was 6.
No, 6, we cut it in half to 3, yeah. So 3% is, we're gonna unravel it at 3 rather, because we discounted at 6, but it's semi-annual, okay? Yeah, and we're gonna do this for the 10 periods on it, okay? Good, good. Okay, so 3, we're gonna use 3, not 4, right guys? Same as in the discount, we use 5 instead of the 4. Don't use the stated rate, right? Use the effective rate. This is effective rate. Effective or yield or market, whatever. Okay? Everybody good? Okay, so now what? What was the value when we did the present value and discounted at 3%?
Premium at 3%?
Well, the discount we used was 3%, but it yielded us a premium. That's kind of unfortunate, isn't it? We're discounting the cash flows either way. But if it's more than the face, it's a premium. If it's less, it's a discount. So we're using discount for different things. Just wait. If you ever took auditing, it's unbelievable. We use review for 4 different concepts. And we call them all review. Just to drive you crazy, I guess. But they're all, yeah, so. In fact, review is kind of like an audit. We review financial statements, that's one. We review other people's work. That's another one, kind of obvious. There's analytical review procedures. And then there's review compliance work. Okay, so anyway, yeah.
108 5.
Okay. And yes, this thing is a premium. How big is the premium, obviously, if the face amount is 100,000? 8,530. And what does that really mean? We're going to pay $40,000 in interest payments, but then at the end, we're only paying them back 108. Loan is 108. So what's our real interest, guys?
3%.
It's only 3%, but how many dollars is it? We're making 40,000 interest payments, but we don't pay them back 8,530, so it's 40,000 less the 8,530, isn't it? Yeah, that's it. Around 31, 41. Yeah, that's it, isn't it? Everybody got the idea? You see it, right? This is just economics, you guys. Oh, Frank Raymond was offended the other day in a faculty meeting when I said accounting and economics are the same thing. No, we teach him theory. You just teach him left and right. He didn't say that, but that's what he thinks. Are we a little beyond left and right in here? No, everything's just left and right. It's accounting, right? Remember to tell everybody that. Your entire career to become an accountant. I know left from right, and they pay me $200,000 a year. God, what a deal. Too bad you don't learn left from right. Anyway, friends. No, don't ever do that. That'd be mean. Okay? My daughter never tells her friends how much money she makes. She went to college with. Working on it for basement. She doesn't tell me either. I don't want to know. More than I make. Rotten trash. Yeah, anyway. She's going to be 40 soon, though, so she's getting old. I told her that, too. I pointed out to them that their grandkids, I love doing this. My grandkids think that their parents are about as old as their Nana and Papa. So who's oldest here? You know, and so my poor son-in-law's older than Nana. Nana dyes her hair, right? Well, I don't know that for sure, you know, right? Anyway, Nana dyes her hair. She's only 10 years younger than me, 11 years younger than me. And, yeah. But certainly my son-in-law is, I don't know, 15 years younger than her or something. But the kids all think she's younger than him. I just think it's really fun. So I ask them over and over. And I say, yeah, that's the way it is. Okay, anyway, let's do both sides, okay? Let's do the investor. Oh, I switched them on you, didn't I? That's mean. Let's do the investor, and let's do the issuer.
Oh, I really can't. Come on.
You got to flip them around now. Way to go. Don't anticipate. You can put them any order you want. You can run them that way. Just keep them that way. Be fine. All right, investor and issuer, right? The investor is also the what? Purchaser and lender. Okay, yeah, this is the same person, right? The issuer. Borrower and seller. Yeah, sure. Okay, so we don't need to write it down. All right, so on January, let's say it's January 1st again, year 1. Okay? I want you to write it down. This time you're going to have a premium. Okay, how much cash changed hands, right? Who got it? Who gave it up? Put it in the right place. You're going to have an investment in held-to-maturity bonds on one side, the investor, right? And you're going to have bonds payable and a what on the other side? Premium. Go ahead and write it. Good. You guys can figure this out. Trust me, when I did my PhD program, it was really like that. They'd have us read stuff and have us discuss with each other what it meant. And we'd sit there and watch it. Really stressful, horrible. I learned how to teach yourself, right? Learn from your own. Far more efficient is to read something and know what you talk about. It'd be cool if you just read that book and you knew how to do it. Keep working on your brain if you can. Not this semester. By the time you're done, your undergrad, that's cool. Everybody got a journal here written down? The hard part was getting 108, 530, right, guys? That's the hard part. The rest of it's just really nothing. Okay? I don't know if that's all that hard. It's just a lump sum and an annuity, right? Calculate the value of each atom together. You know what the value of the bond is. Okay, so what do you want to do on the investment side? Debit what? Investment in what? Held-to-maturity bonds, right? Good. How much? Yeah, it's 108, 530, of course. What did they give them for it? They had to give them cash to get the investment, right? Credit cash, guys. I heard somebody say it out there. You have that on your paper already? Oh. Okay, what happens to the issuer? I bet they got the cash. How much? Okay, what else?
Credit bond.
Yeah, because we always do them just by convention. How we do it, by convention. We always record them in face, okay?
Credit premium bond payable.
Yes, premium on bond payable.
For 800.
That's it. And I'm really pleased that you answer those questions you were so aggressive about. So now I'm going to pick on you for it. That's what happens in life. When you're sitting in a business meeting and you're aggressive and you're confident and you ask questions, they'll ask you something you don't know on purpose, right? So you might know this, though. What do you call this account? I bet you don't, because I don't know if the author even said what it is. What kind of account is that? It's not a contra liability, right? Like the discount is. What is this thing? It's a what? An adjunct. That's a term for it. Did the author use that term? You did. Okay, but that's one term for it. Addendum I like better, though. Doesn't addendum sound cooler than adjunct? An adjunct is kind of like, when I was an adjunct professor, that meant they paid us nothing and treated us like, awful. Okay? Yeah, okay. I'm recording. I shouldn't use too much profanity. I never do I? There's never profanity or a sexist term or criticism of the administration or anything on my tapes. Luckily, nobody's ever going to listen to them, right? Who would? Yeah, who would? So, okay, who told Molly that I said she met some Australian kid? Was that the other class? Listen to the other class. I told you guys that? Somebody, one of my students now ratted me out with Molly. I got a phone message from her, right? I get crap from her all the time. She's really sweet. Sorry, Mom. Yeah, anyway, she's really sweet. And so she sent me this really hateful thing saying, what did you do telling them about my love life and all this stuff? And so then I sent back and I said, well, I'm just trying to encourage them to do international travel. I mean, you get to meet, people and stuff, but yeah, and build your career. And she sent it back and said, gotcha, I think. Yeah, anyway, no, I didn't think she was serious. So she said, anytime. You can make fun of me anytime you want. She thinks everybody should do international. So do I. I think if you did an international semester in, at least do an international summer, you guys. Right? Go somewhere, right? Well, yeah, that's true. In Australia, don't do summer. But, Florence is just beautiful in the summer. It's really nice. That's far enough north. Austria is fantastic. You can go to Costa Rica. I mean, you can go almost anywhere in the world, you guys. Right? No, how many are doing international while they're a college student? How many are doing an international semester? Guys, do the 2-week ones. The School of Business has some 2-week ones that go to Florence, I think. When I went on that one. That was really cool. It was fun. Students, all they wanted to do was go drink. Because, you know, you're 18, you drink. And so they're all out drinking, and so I'd sleep, and then while they were getting over their hangovers the next day, I went to every single museum in Florence. It was just unbelievable. What a place. So, and I never put up with those kids either. So, no, I'm kidding. We did a lot of stuff together. Okay, it was a lot of fun. All right, anyway, so do the one then. Do what's going to happen on the first payment. Go ahead and do it. Same stuff. How are you going to calculate the interest? That's all you got to know, right? And of course, the interest payment's the same amount. And this time, instead of amortizing a discount, you're amortizing a premium. Big deal. And you know what? After you calculate the interest, it's going to be different than the cash, and that'll let you know what you do to the premium, right? And on the investment in the bonds, it's over 100,000. You want to bring it down to 100. That's what you're going to have to do. Guys, still stressing me out. I ask you to do something, you sit there and stare at your paper for a while. I'll do that. Just do it. Come on. This brain's working. This is a nice skill anyway because you can use it in a whole lot of different environments. Being able to amortize debt. Really good. Anybody ever works for a bank ever in their life? Or does business with a bank? Like borrow money? Yeah. It's a really good thing to know. Yeah, if you ever do that, you know, buy a car, buy a house, start a business.
You know, I understood what was on my interest line for my car. That was kind of cool. Yeah.
It's depressing.
That dude was trying to explain it to me. I was like, that is
That's wrong.
shut up, right?
Hope you didn't say it quite like
No, I
that.
didn't, but.
They haven't given you the car keys yet. Yeah. Yeah. I suddenly realize that you do not know what you're doing. That's fun when you're doing business with people and you realize that. That's a lot of the task. When you're hiring people, you just have a conversation with them. And they'll let you know that they either do or don't know what they're doing. And it's real easy. Real easy. Everybody likes to talk. Don't forget your task. All right, how much interest, everybody? What's the carrying value of this thing anyway? I think it's 108,530. This one's easier to get, isn't it? I think it's 108,530. So wouldn't you take 108,530 times what? What you discounted at? Yeah, don't use the 4. That's the most common screw up here, right? Use the 3%. Although some people would actually discount it at 4 and then compound to 3. And don't do that either. Okay, so 33, huh? All right, anyway, how much is that?
32,560.
What's that going to be? Interest what? Expense. It's the same entry, right, guys? Debit, interest, expense, and credit cash, of course. Okay? It's going to be 3,256. But the credit's going to be 4,000, isn't it? You know what the payment is? Yeah, okay. What's going to be on the other side? Issuer. Debit cash, 4,000. Credit what? Interest what, everybody? Revenue. So that's all the same, whether discount or premium doesn't make any difference, right?
Yeah.
Oh. See, I wanted to do it the way he did it. Good thing somebody said something before I filled out the whole page. Thank you. All right. Okay. Should have left them that way. All right. So this one has got the interest revenue, don't they? I think if I loaned the money, I'd want them to pay me the interest. Come on, Keith. Okay. Cash. Cash was 4,000. Right? Interest revenue, 3,256. Does everybody see where the 3,256 came from? Carrying value times the discount rate, right? That's it. Okay? All right, over here, they're going to pay out the cash, of course. They borrowed the money, and they have interest expense. True? All right, finish it then. What else do you need? Yeah, you're going to have to get rid of your premium. I need a debit, don't I? How much is it? 744. Here I need a credit, don't I? 744. So what's happening? I'm getting rid of the premium. The premium is in a separate account there, isn't it? But I'm going to get rid of it. So here you have that premium on bonds payable with 8,530 in it. And then you also have a bond payable with 100,000 in it. Everybody agree with that? And now what I'm going to gradually do is get rid of the premium over the life of the bond, huh? And the premium is going to go down to what by the end? 0. after 10 payments, right? So this is going to be premium on bonds payable. So it's the same as discount, only different, huh? You like that? Same, only different. What are we going to do here? Here I have a bond investment in held to maturity bonds. That has 108,530 in it, and what do I want it to be by the time I'm done? Just 100, because that's what's going to be paid off. Yeah. So I'm going to take the 744 out of there, aren't I? That'll do it. So we're still amortizing premium. Do you see why at the beginning of the class I told you guys not to memorize stuff? To the awful way. You can't memorize. Bordering on impossible. But it's simple, isn't it? It's intuitive. It just makes sense. Okay? Do the next one. It'll only take a minute. We got a minute. Do the next one. That'll be December 31st, year 1. All you got to do is get the new carrying value and take it times 3%. You got it made, right? What's the new carrying value anyway?
107.78.
Okay. Take that times 3%, would you? What does that give you?
3234.
3234. What do you want to debit? You invested in it. Cash. 4,000. What are you going to credit? Interest revenue. How much? 3234? What's the difference? 766? You know what that is? What's that going to be? Get rid of some more, get rid of some of that investment until you get it down to 100,000, huh? So you're amortizing the premium then. Told you it only took a minute. How about this side? They have interest expense, don't they? How much is it? 3234. Credit? Cash. I'm going to amortize my what? Premium. I'm going to take another 766 out of that premium, aren't I? And I'm going to keep right on going. Okay, and this is going to be what? Premium on bonds payable? Okay, what's the journal entry after I do it 10 times? After I do it 10 times, what's going to be the balance of the premium? Zero. What's going to be the balance on
100.
the bond? 100. What's the journal entry when it's paid off at the end of 5 years? What's going to happen to the people who bought the bond? Debit, cash 100,000. Credit, investment held maturity bonds 100,000. What's going to happen to the people? You can see me pointing at the screen, can't you? Okay, the other side. Anyway, what's going to happen over here? They're going to be debiting the bond payable for 100,000, crediting cash for 100,000. Aren't you glad you stuck in here and got to the easy stuff? Actually, the way you guys are studying now, the way you guys are learning things, you're going to max these points, aren't you? This could be 40 or 50 points. Wow. Right? Why not? It's tough stuff. I'll give you points on that. Good. Work on it. Work on it. Work on it. See you guys.